Hello guys, and welcome back to the Cedi Investor. In today's video, we are going over Unilever Ghana. I'm sure everyone knows Unilever Ghana because their products are very dominant in Ghana. They operate in nutrition, home care, beauty, and personal care, laundry, household products, and skin cleansing. Like, they have a lot of products. If you're an average Ghanaian, it will be very difficult to go the whole day without using at least one Unilever Ghana product. I mean, look at all these products they have. Today when I woke up, I used Pepsodent to brush my teeth. Omu. I ate bread and Blue Band today. Lipton, everyone uses it. Like, almost all their products are quite dominant. Even if you want to buy something else, you usually refer to a Unilever product. So let's say you want to even buy some sort of toothpaste, you even say, oh, I'm going to buy Pepsodent or something like that. So it shows how dominant they are in the Ghana market. But despite this dominance, the company's financials and fundamentals is a little bit different. I have the Q2 statements. We are going to go over that and I'll give you my thoughts on it. I'll also give you my thoughts on its current share price and tell you if I think it's worth buying way more or not. Let's get into the video. So when we look at the current price, the company is currently trading at 20.4 Ghana cedis. It's up about 4% year to date. Started off the year 19.5 and it's now trading at about 20.4. So not a quite massive appreciation. The PE ratio 46, trading at a 46 PE. I've never seen a company in Ghana trading 46 PE. That's quite huge. Earnings per share of 0.4, net income 27 million, quite small, especially if you factor in they made a revenue of about 987 million, almost 1 billion. It has a market cap of 1.28 billion Ghana cedis. When we look at their Q2 quarterly reports, we can see that the company reported a 12% increase in revenue in H1 2025 compared to the same period last year, driven by strong contributions from beauty and well-being and the oral care categories. Operating profit margin at 9% is lower than the prior year 15%, driven by a lower gross profit margin. This emanated from higher import cost of raw materials in half year 2025 versus half year 2024. Our bets offset by lower administration costs and other expenses relative to turnover. So basically, they are saying that their revenue went up for the period, but because of higher import costs for raw materials, their operating profit margin actually went down. And even though it was offset by lower administrative costs, so they reduced their salaries, they reduced some of their expenses, but because of high cost of operations, which is raw materials, their operating profits actually went down. So when we look at their income statement for half year, we have revenue went up 476 to 533, but because of cost of sales, which went up from 273 to 341 million, their gross profits actually went down. And the same can be said for operating profits, which went down from 69 to 49. But this one thing I want to note out to you guys. Administrative expenses here went from 73 to 78. We also have other expenses like distribution expenses going from 9 to 10, brand and marketing 55 to 56. The only expense that actually went down was impairment release on trade receivables. We went from 263 to 209, and also restructuring costs as well. So they have in their own reports saying that administrative expense and other expenditures went down, but because the cost of sales, which is raw materials, went up, they made less operating profit despite an increase in revenue. Now, I just want to put it out there to you guys because hopefully maybe my eyes are not working today and I can't see it well. But then administrative expense here is actually going up. So distributing expense is actually going up. So what exactly are they saying? What form of expenditure is going down? We really have impairment release and restructuring costs that literally went down. Even other income went down compared to last year. They ended up the period with less profits. I mean, they made less than half of what they made last year. And basically the earnings per share is also going down. I mean, they clearly stated that despite higher cost of raw materials, it was offset by lower administrative costs and other expenses, even though it was not enough to keep operating profit margin higher than last year. One thing that I like about Unilever Ghana is that they have a dominant moat in Ghana. So you can see it from their revenue here. steadily increasing. I mean, the growth actually slowed down from 2023, but it's still increasing each year, which is very good to see. But then again, it's not translating into enough free cash flow for me as the customer. It's also not translating into higher margins when it comes to either profits or operating margins. And we consider the main reason is because of the expenditures. The expenditure of the company has literally doubled over the past 2 years, whilst the cost of revenue has been increasing at a steady pace. So we consider the cost of materials that they are claiming is increasing. It's not increasing as fast as other expenditures like administrative expenses, and because of that, now we can see that their revenue is steadily dropping. They are making way less revenue compared to what they were making previously. Not a great thing to see. Another thing that I saw was quite interesting is if you see their operating cash flow, they were able to generate about 34 million as of trailing 12 months, but they paid dividends of about 40 million. So they are paying way more dividends than what they are actually generating, which we can see is a big blow to their free cash flow. So if they are not generating enough for you as a shareholder, they are consistently paying dividends at this rate, they won't be able to, first of all, be consistent with these dividend payments, and secondly, they can't continually grow these dividends. It wouldn't make sense for them because they are literally generating way less than what they are paying in dividends. Even if you check their price to earnings ratio, we can see that it is about 46.51, and when you compare to the previous years, 20 for 2024, 3 for 2023, and 16 for 2022, we can see that it's at the highest that's been in the past 3 to 4 years, indicating that the company is trading at massive high valuations. Meaning, if you are buying the company today, you are buying it at the most expensive it has been over the past 4 years. And the same can be said when you check my discounted cash flow. I'm giving this company relatively easy assumptions. I'm assuming that it's going to continue growing its free cash flow by 50% each year. And using those assumptions, the discounted cash flow of 10%. Based on these assumptions, we can see that the implied value per share of Unilever Ghana is 10.67 Ghana cedis, which is a 47% difference from what the current share price is of 20.4. So essentially, based on these assumptions, I believe that Unilever Ghana is massively overvalued based on its fundamentals and the trajectory of the company, how fast it's growing, and how much cash they are generating for their shareholders. The company is definitely not worth 20.4 by all standards. But then again, these are just my opinion. Thank you so much for watching. Comment down below what you think about Unilever. Do you own it or not? Are you planning on buying it or not? I would love to know your thoughts, and also what you think about my DCF model and everything I've said about Unilever Ghana. I would love to know. Comment down below, like the video, share with people you think might be interested, and also subscribe. I would really appreciate it. Thank you so much. Until we meet again, have a wonderful and blessed rest of your week. Peace.